Welcome back to Investing Talk Podcast.
Today, we're looking at Hewlett-Packard Enterprise.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And we are really dissecting one of the most interesting strategic conflicts in tech right now. Yeah. You've got Hewlett-Packard Enterprise successfully executing this massive pivot toward, future computing, AI infrastructure, quantum, supercomputing.
All the right buzzwords.
All the right buzzwords, exactly. Yet the immediate financial returns look, frankly, terrible. The market is just, it seems paralyzed, unable to reconcile that explosive revenue growth with shrinking profit margins.
Okay, let's unpack that financial paradox then, because the Q3 2025 numbers for the quarter ending July 31st, they really show this perfectly. On the top line, things look phenomenal.
Right.
Nearly 20% revenue growth year over year, hitting $9.2 billion. That signals, massive demand for what they're selling.
Exactly. But then you flip over and look at the bottom line and, well, it's a horror show for any short-term investor.
Horror show is a strong word.
Earnings per share dropped sharply. It went from $0.38 all the way down to just $0.21.
Wow.
That massive miss on analyst expectations is exactly why the share price dropped, 3.9% right after the report.
Okay, so when a company posts 20% revenue growth but profit just collapses, the first reaction is always that management has lost control of expenses. But you're suggesting this isn't just, poor cost management.
No, I think there's a strategic explanation for this margin compression.
Which is?
It's the cost of entry. It's the price you have to pay to get into the next generation of computing. Winning these massive proprietary AI and supercomputing contracts that requires huge immediate capital expenditures.
So we're talking massive R&D, specialized staff.
Massive R&D, hiring the right people, and building out capacity before that revenue stream even really starts to materialize and scale up.
Okay, so it's a purposeful trade-off. A painful one, but purposeful.
It is. They're spending big now to establish that market share in these high-margin sectors that will hopefully pay off later.
So investors are basically punishing them for making what sound like necessary investments. Management did try to manage expectations, right? They set the fiscal 2025 EPS guidance at $1.89, and we also saw those layoffs announced in September.
They did, and that indicates they are trying to tighten the belt, once this heavy spin wave subsides.
But the market's not buying it yet.
The market wants proof. The layoffs confirm they're now focused on optimizing, but Wall Street wants to see that these massive contracts, like the ones that drove that 26.1% net income growth in 2024, can translate into sustained profit, not just one-off wins.
All right, so let's pivot to those wins, because this is where the bull case really lives, right?
It is.
You mentioned high-margin areas, AI and supercomputing. What kind of competitive moat are they actually building here?
The moat is all about proprietary hardware and exclusive access, particularly within the public sector and advanced research. We've seen these major contract expansions, like their collaboration with the U.S. Department of Energy and AMD to build next-gen supercomputers.
And these aren't just commodity sales?
No, not at all. These are bespoke, high-value, long-term deals.
And they also hold exclusive contracts with places like Los Alamos and the University of Utah. I saw that in the sources.
Correct. Plus, they're heavily invested in building out what they're calling sovereign AI platforms.
Okay, break that down for me. Sovereign AI.
So basically, it's infrastructure designed for governments and large organizations that need to develop AI using their own sensitive national data. That data literally cannot leave the country or its secure network.
So it creates a proprietary, regulated market where very few companies can even compete.
Precisely. It's a layer of protection that a pure-play AI startup just can't easily breach.
Okay, now you also mentioned something that sounds like it's straight out of a sci-fi movie. The Quantum Scaling Alliance. What is that, and why should an investor care?
This is potentially the biggest long-term differentiator. In October 2025, they formed this alliance with 7 key partners. And it isn't about selling quantum computers today. That's still a very new field. This is designed to merge the future, quantum computing, with today's high-performance supercomputers.
And the goal of mixing those two?
Is to accelerate breakthroughs in completely new areas. We're talking about complex drug discovery, huge optimization problems like global logistics, and preparing for post-quantum security solutions.
The kind of security we'll need once current encryption is basically obsolete.
Exactly. They're positioning themselves to be an enabler for the next technological revolution. It's way beyond just selling more GPUs.
That vision is massive. But speaking of big moves, we have to talk about Juniper.
Yes.
They have these bold ambitions around networking expansion through this acquisition. Where does that stand?
So the Juniper integration is really the crucial balancing act for the short term. The acquisition is expected to close soon, and it promises to dramatically enhance their networking capabilities,
In what way?
specifically in automated cloud-based networking solutions. The upside is huge. It makes their whole offering much stickier and broader.
But any large acquisition like this carries massive risks.
Absolutely. This is the main part of what we'd call execution risk. Can they merge two huge, complex companies without disrupting sales, losing key people, or just stalling out the integration?
If they fail, it could crush any margin improvement they're hoping for.
It would completely offset all those big AI contract wins. It's a very high-stakes, all-or-nothing move in networking.
So we have these big growth engines. Let's look at the foundation. Is the balance sheet healthy enough to handle all these giant bets?
It's remarkably strong, which, is a key pillar of the bull case here. They've got a very strong cash position, their debt-to-equity levels are prudent, and critically, their free cash flow is stable and rising.
And free cash flow is what pays the shareholders, right?
Precisely. And that consistent FCF supports their dividend, which is currently yielding about 3%.
Which is pretty high for a tech infrastructure company.
It's significantly above the peer average. This makes the stock appealing to a certain type of investor, maybe a risk-averse growth investor, who might be wary of pure growth plays.
And management seems to be guiding for a profit comeback based on this. They're targeting, 5–10% revenue growth in fiscal 26?
Yes, and they're assuming these AI contracts mature in scale. And the analyst community, at least on paper, seems to believe them.
What's the sentiment there?
It's overwhelmingly bullish. Out of 18 analysts, we have 31% rating at a strong buy, 25% buy. Nobody has a sell rating on it.
And the price targets?
The consensus 12-month target is at 26 targets, which would be a 13 to 14% gain from where it is now.
Okay, that's where my skepticism kicks in a bit.
Go on.
If the balance sheet is strong, the strategy is pioneering, analysts are universally bullish with a $26 target. Why is the stock struggling to hold $23 right now?
It's a great question.
Are the analysts just ignoring the integration risk, or are they too focused on buzzwords like quantum?
I think the market is just waiting for tangible proof of margin expansion. That's why these immediate catalysts are so important. That $26 target requires absolute execution on two fronts: a successful Juniper integration and turning those AI deals into actual profit.
So the stock price is just discounting the possibility of failure.
Exactly, which is why it hasn't popped yet.
That brings us right to those short-term catalysts. What should we be watching for the next 3 months?
The immediate number one focus is December 2nd, 2025. That's the Q4 earnings release.
The moment of truth.
It is. The last report proved they can win contracts. Q4 needs to prove they can convert those wins into sustained profit and show real margin expansion. If they beat guidance, the stock moves instantly.
And beyond the earnings report itself, we have those market-wide events in December.
Right. Keep an eye on the institutional 13F filings on December 15th. That'll show us if big funds have been quietly buying up shares. Then you have the S&P and ETF rebalancing around December 20th, which can cause some short-term trading volume.
Now let's talk about the rumors you've been tracking. These are the things that can really add unexpected fuel to a price move.
So we have three key rumors floating around. First, there's chatter about potential strategic acquisitions of smaller, specialized AI startups.
To fill in any gaps they have.
Right. If they can buy some missing tech, that's immediately bullish.
And the second rumor is about more cost cutting.
Yes, ongoing speculation about further workforce optimization. If they can aggressively improve margins now without waiting for the new contracts to scale, the market would love that decisive action.
Okay, and the final one, the quantum rumor.
This is the high-risk, high-reward one. There's anticipation of some early pilot deployments or even commercial breakthroughs from that new quantum scaling alliance.
So if they could announce an early win.
If they announce, say, a successful drug discovery project for a major pharma partner, that would be a massive statement. It would be early proof that the long-term vision can actually be monetized.
Let's ground this in the technical picture. As of November 12th, the price is around $22.89. Is the long-term trend still bullish, even with that recent earnings hiccup?
It is. The stock has been consolidating, moving sideways between about $21.50 and $25.30. But the major trend over the past year is still bullish. And crucially, it's trading above its 100-day moving average at $22.50 and well above the 200-day at $20.03.
Which confirms that midterm bullish bias.
A very solid one, yes.
So what are the key technical levels traders should be watching?
The most important support zone is between $21 and $22. Holding that level is key.
And on the upside?
On the resistance side, look for a break of that recent high at $25.30. A clean break above 26 cents hitting that analyst target would signal the market is finally re-rating the company as a true next-gen leader.
We covered the execution risk with Juniper, but what's the other major risk factor for a company making such huge transformative bets?
It has to be competition risk. The AI infrastructure space is incredibly competitive. HPE risks failing to keep pace not only with the huge public cloud providers, your hyperscalers like Amazon and Google,
Who have massive
budgets,
Yeah.
but also with more nimble, pure-play AI competitors who can focus just on innovation without being weighed down by a legacy hardware business.
So let's sum this all up. You have a company that's shedding its old skin, pivoting to the future, but incurring massive cost right now to do it. What's the final verdict?
We rate the overall investment thesis as bullish, an 8.5 out of 10. This stock is unique because it kind of serves two masters. It has short-term trading appeal with those December and January catalysts,
Especially the Q4 earnings.
especially earnings. But fundamentally, it offers this rare blend of high growth potential from the AI and quantum pivot, plus a high 3% dividend yield.
So it's not a pure growth stock, but more like a growth engine with a bit of a safety net.
That's a great way to put it. It's perfect for the long-term investor who wants AI exposure, but needs the stability and income from a strong balance sheet and a consistent dividend. It really sets it apart from those high-flying zero-income growth names in the sector. The company's ability to prove its thesis hinges entirely on the Q4 earnings, which must show that the short-term pain of high investment is finally starting to convert into tangible, sustained operating profit. Otherwise, that strong dividend may be the only thing keeping the price tethered.